So you asked me what is the good, the bad, and the ugly. So let me start with the good, because we always want to see what is good first. So the good thing, as you said, is that GDP growth in the first quarter came in at 20.1%, quite unlike the contraction that we saw in the first quarter of the last year, when GDP actually contracted by 24.4%. But remember, that was also the period when we had the lockdown. So we take it with a pinch of salt, but it is definitely good news. So that really is the good news at the overall level. And the gross value added, that also grew by 18.2%, as against, 18.8% as compared to 2.4% contraction in the previous period. So overall headline numbers, both of GDP as well as GVA, are good. Another bit of good news is that every sector, unlike in the comparable period last year when only agriculture grew and every other sector contracted, in this quarter, every sector has grown. Of course, as I said, again, compared to the low base, but in the case of agriculture, we actually saw agriculture grow at 4.5% during this first quarter this year, as against a comparable growth of just 3.3% in the last year. Even better, if you look at the fact that this 4.5% growth has come during the time when we saw farmer agitations in a lot greater part of North India, particularly Punjab, Haryana, western part of UP, we did see farmers agitating against the farm laws. Very welcome, very needed reforms, but farmers misguidedly were protesting against it. So the fact that agriculture has grown at 4.5% is really a shot in the arm for government's efforts also to reform agriculture. So this really is a good part. Another good thing is that we saw construction, manufacturing, and trade, three sectors that are heavily labor intensive, which employ a large number of people, particularly in the case of construction and trading, those who are really at the bottom of the pyramid. These sectors have grown very well. That means that jobs are being created, incomes hopefully will be generated. And so the distress, at least the human distress that we saw because of the pandemic, that perhaps is getting ameliorated. The not so good part, of course, is the fact that you have to take it with a big pinch of salt, simply because these numbers get a boost because of the contraction, the decline that we saw in the comparable period last year. Again, the not so good part is that if you look at gross fixed capital formation, which is really the investment, that again has not grown at all. In fact, it is still, and it's a very marginal increase as a percent of GDP. Again, the not so good part really is the fact that if you look at the absolute number, the GDP generated, that is the gross value added plus taxes minus subsidies, that in the first quarter of this year is less in absolute terms than what it was in the first quarter of 1920. That means today, the GDP, the contribution from the economic activity during the first quarter is less than what it was in 1920. That means we really have to make up, we have to go back a full year. It's as if 2021 has been a complete washout. We knew that, of course, but we haven't even got back to where we were in 1920. So this is true not only of GDP, but also of investment. Government expenditure, even though that has grown by 5.8% as compared to a contraction of 10% in the comparable period last year, it is still nowhere near adequate to hold the proper economic growth in the country. Economic growth, basically, if you look at it, there are four components. There is private consumption, there is private investment, there is government consumption and investment, and there is exports. Now, private consumption, because of the lack of income, unemployment, COVID, etc., private consumption is not looking up. As far as private investment is concerned, we have excess capacity. There is very little demand, again, because of loss of incomes, unemployment, etc. So we're not going to see private investment take place. There is already excess capacity. Exports is one driver which perhaps could have helped us. And we have seen exports do quite well. But recently we are seeing that the rupee has appreciated substantially. And hence, there is a possibility that exports will not do so well simply because the rupee has appreciated and exporters, as you know, don't gain. This would normally have been mitigated by the RBI. RBI would have bought up dollars and pumped in rupees. But at a time when inflation is already high, RBI's hands are tied. So if the rupee appreciates, this export engine, which is helping prop up growth at the moment, that might also falter. The last engine, which is perhaps the most important at times of stress, is government expenditure, whether it is consumption expenditure or investment expenditure. And unfortunately, as I mentioned, this is where we've seen government expenditure grow only by 5.3% at a time when, as I said, if you look at the economy opening up, if you look at the fact that in the first wave of the pandemic, both human cost as well as economic cost was high, but economic cost was far higher simply because the entire nation went into a lockdown. In the second wave of the pandemic, economic cost was not so much, human cost was much higher, simply because in the second wave, we didn't have a national lockdown. We had lockdowns, regional lockdowns. So at no time really was the entire country locked down. Even now, we're seeing it is only Kerala, which is having almost 65% of the COVID cases are in Kerala. So it is this dispersed kind of effect which has resulted in the economic impact of the second wave being less severe than in the first wave. So at a time like this, we are seeing government revenues are doing quite well. In fact, government revenue receipts are up in the first quarter by 3.9 lakh crores. Unfortunately, government expenditure is up by only 5,700 crores in the same period. So at a time when government's tax coffers, revenue coffers are doing so well, why is the government being so parsimonious when it comes to spending? This is the time when the economy needs a crutch, needs that hand holding. And unless the government steps forth and supports the economy, we're not going to see this growth being sustained. Hopefully, now that we have a national monetization pipeline, we have a national infrastructure pipeline, that means the projects are there. Now, government has the money. In fact, it doesn't even need monetization. Its revenue receipts are doing quite well. Hopefully, the government will shed its shyness, shed its parsimonious ways, and start spending, in which case, the growth which we've seen in the first quarter, even though the subsequent quarters may not see growth at 20%, it will see growth upwards of 6 to 7%. And that, if we see 3 successive quarters of growth in the region of 6 to 7%, then overall, we should end at that 9.5% that the RBI is estimated for this current fiscal. Of course, all of this goes with the one big caveat. A, that the vaccination drive continues and in fact picks up speed, because we're nowhere near where we should be if we want to ensure immunity for the bulk of the population. And the other big caveat is that there is no third wave, or even if there is a third wave, it passes off much more mildly than even the second wave. So with these two caveats, I think we should perhaps be on the path of recovery.